Hey y'all, John Cannon Mortgage Broker here. It's good to have you. We're going to talk about the different qualified mortgage programs out there. Loans are categorized into two different buckets. There's non-QM loans, and then there's QM loans or qualified mortgages. So non-QM loans can have some things like risky features. Maybe there's a balloon payment at the end of a 5-year period, or maybe there's an interest-only period, or maybe there's negative amortization for a time, or maybe they charge excessive fees at closing. Non-QM loans sound pretty bad. So why would people do a non-QM loan? Non-QM loans can be great for certain types of people. They can be great for real estate investors, people that have an I-10 and maybe don't qualify for a normal conventional mortgage. But I want to talk about QM loans, qualified mortgages. Let's jump into the different qualified mortgage loan programs. First, conventional. Second, FHA. Third, USDA. Fourth, VA. And fifth, jumbo. Let's jump into conventional first because most people have conventional loans. Conventional loans, you can put as little as 5% down on a conventional loan. And if you're a first-time home buyer or you make 80% of the median income limits in your area, you can put as little as 3% down. As a rule of thumb, a lot of people that are first-time home buyers can qualify for just 3% down. With conventional loans, the best borrower is going to be someone that has over a 680 credit score. If you have lower than a 680 credit score, it doesn't mean you won't qualify. There's just some other programs that might be better for you. Conventional loans have loan limits. So you can generally only get a conventional loan if your loan is below, in 2022, $647,200. But that doesn't mean you can't qualify for other loan programs if your home is over that value or the loan amount is over that value. It's just conventional loans are generally $647,000 and below. Now that varies by county. I live in Utah and I work in Colorado as well, and there's some areas and counties that the loan limit is higher as well. If you're looking at buying a duplex or a multiplex of 4 or 3 or 2 units, the loan limits are a little bit higher than that. So make sure to get with your loan officer and talk through that. Putting 5% down or 3% down on a loan is great for a lot of borrowers. However, there's something called PMI, or private mortgage insurance. Private mortgage insurance is charged on loans when you put less than 20% down. Let's say you put less than 20% down, but you don't want to pay mortgage insurance. You can actually pay a cost up front to buy out mortgage insurance most of the time. And lenders have different programs where maybe it's more beneficial to go with a program where you put 10% down and there's no mortgage insurance. So make sure to get with your loan officer and talk about the different options you have when you're putting less than 20% down and going on a conventional loan. There's no upfront cost or funding fee to get into a conventional loan. There are closing costs like title fees and potentially some underwriting fees, property taxes, escrow fees, recording fees with your county. Those fees you will have to pay at closing with any type of loan. But a conventional loan, there's no funding fee. And we'll get into it a little bit more when we talk about these other programs. Let's talk about FHA loans. FHA loans are still a pretty low down payment, 3.5%. So a great option for a lot of people. You can go down to a 500 credit score. So let's say you're a first-time home buyer or you've had some life experiences and your credit score got a little bit lower. FHA loans are a great way to get into a home. It costs a little bit more, but you can get into a home with a lower credit score and start building your credit score up. FHA loans have loan limits just like conventional loans. And you have to get with your loan officer to see what the loan limit is for your specific county. One of the drawbacks about FHA loans is the mortgage insurance premium. So we talked about PMI or private mortgage insurance. FHA loans have MIP or mortgage insurance premiums. Now, generally, it's about 0.85% of the loan amount that you pay each year in your mortgage insurance premiums. But depending on how much money you put down and the loan amount, it can be a little bit more or less than that. But 0.85% is a good rule of thumb to follow. Also, another drawback is that when you get the loan at closing, you have to pay a 1.75% upfront mortgage insurance premium. Now, this 1.75% amount can be rolled into the loan. For example, let's say you get a loan amount for $400,000. Your upfront mortgage insurance premium for an FHA loan would be $7,000. Now, you can roll that $7,000 into the loan amount. So you may be purchasing the home, paying your 3.5% down to get to $400,000 as your loan amount. Your actual loan amount will be $407,000 because that 1.75% upfront mortgage insurance premium can be rolled into the loan. Because they're backed by the government and they're FHA insured, the loan rates are generally a little bit lower because they're less risky. The next loan program I want to talk about is a hidden gem, especially in Utah and Colorado. A lot of people don't take advantage of USDA loans because they just don't know about them, or their loan officers don't know about them. USDA loans are 0% down. That's right, 0% down. You can have a really low credit score, down to 500, but ideally you're above a 640 just to make it easier for you and the loan officer. When you get into those lower credit scores, sometimes there's little things that just cause the loan to not go through. Life experiences that happened, or the lender gets a little bit nervous because something happened in your credit history. The other thing about USDA loans is there's no loan limit for guaranteed USDA loans. Now, there's two different types of loans. There's direct USDA loans and there's guaranteed USDA loans. We're talking about guaranteed USDA loans right now. The other thing about USDA loans, similar to FHA loans, is that there's an upfront guarantee fee of 1% on the loan amount. Similar to FHA loans, you can roll that guarantee fee into the loan amount. There's also a guarantee fee that you pay monthly of 0.35%. And that 0.35% you pay is based on the loan amount. Another really cool thing about USDA loans is that you can actually roll your closing costs into the loan. So let me give you an example here. Let's say you're getting a $400,000 loan with a USDA loan. You have a 1% fee, so that's $4,000. You can roll that into your loan amount like we talked about before. So your new loan amount is $404,000. Let's say you're putting nothing down on the home. You're purchasing the home for $400,000. When you get your appraisal, if the appraisal comes back higher than the purchase price, so let's say the appraisal comes back at $410,000, you have $6,000 between the 404 and the 410 that you can put closing costs into, and you can wrap those closing costs into the loan. So you can get into a USDA loan and a home with no money out of pocket. All your closing costs are covered and your down payment is covered and the funding fee is covered. There's a few caveats with USDA loans that disqualify people from being able to do a USDA loan. There's only specific areas where you can get a USDA loan. Now, they are designated rural areas, and lots of people, when I say rural, they start thinking cows and they start thinking big farms. But there are areas close to big urban areas where you can actually qualify for a USDA loan. There's an eligibility map that the USDA publishes, and you can go on, plug in an address, and it'll tell you whether or not that home qualifies for a USDA loan. One thing to be aware of as you look at USDA loans is that there are income limits that you have to meet based on your family size. So get with your loan officer and make sure you meet those income limits before you bank on getting a USDA loan. Similar to FHA loans, it's backed by the government. It's backed by the USDA. The USDA guarantees the loan. And because of that, you can get some lower interest rates. So make sure when you're comparing rates that the USDA loan rate isn't close to the conventional loan rate, because likely that lender is skimming a little bit off the top and not passing the savings along to you. VA loans. VA loans are my favorite, and I've done a lot of VA loans. They are by far one of the best loan programs for borrowers if you qualify. In order to qualify for a VA loan, you have to have a certificate of eligibility. And in order to get that certificate of eligibility, you have to have served in the armed forces. Make sure to get with your loan officer if you have a question whether or not you qualify for a VA loan. The best thing about a VA loan is that it's 0% down, similar to a USDA loan, but you're not confined to a certain area. You can have a super low credit score and still qualify for a VA loan. You can go down to a 500, but it's best if you can be above a 620 so that it makes it easier for both you and your loan officer. The VA loan follows conventional loan limits. So we talked before about the conventional loan limit generally being about $647,000. That loan limit applies to VA loans at 0% down. If you go above a $647,000 loan, you can still get a VA loan, but you're going to have a down payment in order to qualify for that loan. Similar to FHA loans and USDA loans, there is a funding fee. And unfortunately, in most cases, when you're doing 0% down, it is the most expensive of the three loan types. But if you have a service-related disability, you can actually be exempt from the funding fee. So you can have no funding fee, and the VA has no monthly fee as well when you put 0% down. If you're a first-time homebuyer with a VA loan, your funding fee is only 2.3%, so really not that much, and there's no fee charged monthly. If you've previously used your VA home loan and you're getting another home at 0% down, the funding fee jumps up to 3.6%. But if you put just 5% down and you're subsequently using your VA home loan, then that funding fee is decreased. So make sure to get with your loan officer so that you're strategizing how to save the most money when doing a VA loan. The other weird thing about VA loans is the VA doesn't care quite as much about your debt to income. I haven't touched on that yet, but your debt to income is basically how much you pay in debts per month over how much you make per month before taxes. The VA does care about your debt to income, but they don't weight it quite as heavily. So they don't restrict it saying you can only get a loan if your debt to income is below 50%. Potentially you could go higher than 50%. But what the VA does is they look at your residual income. So they look at how much income you make, and then they take out certain things like your mortgage payment, other debts, a fee based on your family size, taxes, your utility bills based on a percentage of your square footage. Now, the residual income is really what the VA is going to look at when you qualify for a loan. So make sure to get with your loan officer and run the numbers and have them run it through the automated software, the AUS, to make sure you qualify for the loan. A lot of companies specialize in VA loans. The reason they specialize in VA loans is they're pretty easy to do generally. The underwriting process isn't quite as complicated. And generally investors are willing to invest in a VA home loan at a lower interest rate. So these lower interest rates should be passed along to the borrower. But a lot of these big banks and companies that specialize in VA home loans, they take that difference and they pad their own pockets. So make sure to get with a loan officer that you trust that's not padding their own pocket and they're passing along the savings to you. The last loan product I want to talk about is jumbo loans. Now, jumbo loans is when you've exceeded that conforming loan limit. Like we talked about, conventional loans cap at $647,200 in most counties. So if you go above that, all of a sudden you're in jumbo territory and the rules change. There's certain requirements that you have to meet in order to qualify for a jumbo loan. So let's talk about it. Most jumbo loan programs are offered by investors that want a 10.01% down payment. Now, most people just say 10% because it's easier. But there are programs where you can go down as low as 3.5%, but they're expensive. So beware of that. You're going to pay a lot in closing costs. There's a lot of fees charged, or you're going to have a higher interest rate. Investors that are offering jumbo loans are generally wanting your credit score to be higher. They want to be really comfortable with your credit score and you as a borrower. So the optimal borrower for a jumbo loan has an 800 plus credit score. I've seen some programs that go as low as 660, but if you drop below 660, it's going to be really tough to get a jumbo loan. There are some loan limits and it varies by investor, But the loan limit that I've seen mostly is $3 million with a jumbo loan. Also, with jumbo loans, because these are offered by investors, they kind of lay out the DTI, they lay out the assets that are required, they lay out the credit score and the down payment. They're not charging an upfront fee or a monthly fee. It can be kind of hard to qualify for a jumbo loan. Sometimes investors require 24 months of reserves or 12 months of reserves, but generally there are some assets required in order to qualify for a jumbo loan. I've seen various debt to income limits based on the investor that's offering the jumbo loan, but it ranges from 41 to 45%. I haven't seen very many programs that go above 45%. So make sure to get with your loan officer so that you know how to qualify for your jumbo loan. The other caveat with jumbo loans is that when you go above $2 million, the investor wants to see two appraisals to make sure the property's really worth what you're paying for it. Now, those are the 5 QM programs that I wanted to talk to you about today. These are awesome programs, and your situation is going to differ from someone else. So it might be that one program is a lot less expensive than another. Now, don't let the banks pad their pockets by pushing you into a certain loan program. Get with a trusted loan officer and make sure you do your research to qualify for the right program.